أعوذ بالله من الشيطان الرجيم. Bismillahirrahmanirrahim. As we begin today. Greetings, traders. It is I, Abdul Shabazz. And this is some real change. Stock options trading journey. And today, Wednesday, September the 18th, FOMC Day. Today is FOMC Day. FOMC report coming out at 2 o'clock. Powell will be doing Q&A around 2:30. Dr. J is in the building. I will be taking it extremely easy this morning. Unless I am forced to trade. Big Money Lance in the building. We'll be taking it easy this morning, Lance, allowing the charts to form. FOMC 2 o'clock, Q&A at 2:30. A plus setup shows up, then we must do what we must do. So without that, it'll be a pretty uneventful morning for me. Thank you, buddy. You want to be safe? slight gap up from yesterday. Yeah, I missed it too. Missed it as well. Bismillah. Make today our best trading day ever. Wow. Bro, you see the prices of the options today? Let me make sure I got the right one. Yeah, they man, you see these prices. Prices are crazy. Yeah. Goodness. They definitely want to make sure I stand aside. I want to eliminate pre-market, especially with this move down, so we can go ahead and show the gap and crap. If I eliminate pre-market, just pull in yesterday and today, you can see the gap and crap. I don't think it's a need for pre-market. Clearly understand the assignment. Got good solid levels here. We're gonna rock with this 5 minutes to go off of. Yeah. Lance, is there rain out here? Yes, Lance, it is rain. Yeah, I just figured I'd bring the rain that was outside, bring it inside. Keep us mellowed out this morning. Yes, sir, buddy. It's gonna be great with this cuppa that I'm getting ready to have. Be right back. And that's exactly why we are standing on the side. Good morning, Brooks, Dan, everybody else. I'm here. I'm just in the background watching.
It's moments like this that keep us moving through life. To enjoy the moments that matter, take a step in the right direction today with Move Free. Move Free Ultra delivers more than just joint comfort. Triple action support. Move Free. Joint health starts today.
Get a butter croissant for a little expense. It's flaky, it's soft, it's now 49 cents. We make them in Europe and bake them in store. And we don't even mind if you flake on our floor. The price and the flavor will make you go, what?
It's time to help people customize and save at Liberty Mutual.
Pumpkin season has officially arrived at Wawa with a whole lineup of handcrafted beverages, like new caramelly sweet pumpkin brulee. Make Wawa your destination for pumpkin coffee, lattes, smoothies, and more. And sip the flavor of fall. Gotta have a Wawa.
ever wondered how the world's currencies are traded? The foreign exchange market, also known as the forex market, is the largest and most liquid financial market in the world. It's a marketplace where currencies from all over the globe are bought and sold in pairs. A currency pair is a quote that shows the value of one currency in relation to another. For example, the British pound against the US dollar is one of many currency pairs that can be traded with Forex.com. The value of individual currencies change over time, often second to second, and speculative traders can take advantage of these changes by buying and selling at the appropriate times in order to make a profit. However, as the market is constantly fluctuating and can move against you at any time, this can also result in losses. What drives the value of currencies? Interest rates and inflation are two of the most important factors. The value of an individual currency will also reflect the demand for it. Traders can profit from the fluctuations between currencies as they strengthen or weaken relative to one another. The forex market is by far
So this is your first time buying a home?
Yeah, this is first time doing any of this.
Everything is in the email I sent you the other day.
The email.
And if you haven't looked at it yet, let's go through it together.
Expertise is one of the many ways an agent who's a realtor works for you.
YouTube Premium is ad-free YouTube and the YouTube Music app all together. Uninterrupted videos and an app made just for music. YouTube Premium. One subscription, 2 apps. Try 1 month free. YouTube Premium is ad-free YouTube and the YouTube Music app all together. Try 1 month free.
Here we go. Here we go. Let's go live right now to the Fed. Crazy. Wow. Nuts. Nuts. Nutty nuts. Damn.
Inflation is moving sustainably toward their 2% target, and the risks to inflation and the labor market. While they do not explain why they decided on a half-point reduction, the statement says the committee is strongly committed to supporting maximum employment. And remember, in Jackson Hole, Chairman Powell said any deterioration in the labor market would be unwelcome. There was one dissent from Governor Mickey Bowman. It's the first dissent by a Fed governor since 2005. It is the first dissent by any member of the committee since 2022. The statement adjusted to say the committee will, as always, carefully assess incoming data, quote, in considering additional adjustments. There's no changes, guys, to the QT portion of the Fed's policy.
Mike McKee, stay close. We'll come back to you. Here's the price action in response to it. Knee-jerk reaction. It's the first move. Might not stick, but this is the move so far. Up by 0.8% on the S&P 500. The overwhelming performance on the Russell.
Knee-jerk reaction.
By 1.7%. In the bond market, just bear in mind, we've come a long way. And we've priced in a lot to this yield curve. The 2-year just climbing just a little bit to unchanged at 360 at the moment at the front end of the yield curve. And in the FX market, dollar yen dropping back by about 0.7%. So that's a weaker dollar, a stronger Japanese yen. Lisa, 141 on that currency pair.
Yeah, now over to the Bank of Japan. And if they hike, how much does that divergence continue? I also want to point out gold. You're seeing a bid into gold right now. We start to look for some of the inflation proxies. So will this sort of feed into that idea? I thought it was interesting. The long end of the yield curve, just on the margins, not significantly, yields just slightly up on this idea that they're going to go bigger and potentially even more down the line.
So the median dot can mask some disagreement beneath the surface. So let's talk about the range and not just the median at the FOMC. The median dot for 2025 in the projection materials that were just published is 3.4%. The range for 2025 is anywhere from 2.9 to 4.1. 2.9 to 4.1. That's quite a range on this FOMC. And I think for the first time in a long time, we have some dissent playing out publicly as well. The first dissent from a sitting governor on the FOMC since 2005. This was not a unanimous decision.
And it really highlights why this actually became such a knife's edge kind of decision. Just to add to that, 10 officials penciled in 100 basis points or more of cuts for this year. 9 officials penciled in 75 basis points or less for this year. It actually matters quite a bit for market expectations, especially given some of the policy uncertainty next year.
So TK, we get 50. We get 50, and now we're waiting for the next act. It's a news conference in 26 minutes' time.
I think it's a surprise. Within the zeitgeist, this is to the edge of surprise. I think Powell maybe alluded to this with his enthusiasms at Jackson Hole. You touched on something Jason Furman touched on this morning, which is don't forget the dollar. And Mohammed Al-Arian, I'm going to be as direct as I can, is the great unknown here a dollar weakness that anybody without gray hair doesn't know?
That we may not know. I think we've seen it before. I remember periods of dollar weakness, but it is dollar weakness. This is not just
$3 on the option chart.
Cut. This is a dovish 50 basis point
in a 2-minute candle.
Right. I mean,
$3.
Now, I agree with you, John, that the dovish dot comes from the median dots. But if you look at the range, it doesn't look at dovish. But that's not what the market is going to hear. The market is going to look at the median dot and will interpret this as a dovish 50 basis points cut. And the first reaction was actually a steepening of both 2s10s and 2s30s, which tells you something about what people are worried about.
To some extent, this median dot validates market pricing coming into this decision. Is that sufficient? I'm looking at equity market reaction right now. We're up by 0.5%. We've still got a news conference, a question we've asked for the last several weeks into this. Are we going to end up with disappointment on the other side of this news conference with Chairman Powell? What would your question be now?
The main challenges before Money.com was tracking data. Things were all living in different spaces.
It will be what has changed since July when you decided not to cut rates And now there's this very aggressive cut and aggressive signaling. What has changed?
The speech in Sintra, Portugal at the start of summer, very different to what we're hearing from the FOMC just several months later. Joining us now to discuss is Bob Michael of JP Morgan Asset Management. He joins us out of London this afternoon. Bob, we just want your first impression to the decision. What do you make of it?
It hit on pretty much everything we were looking for, probably a little less dovish than we thought in two instances. One, there was a dissent, so it wasn't a slam dunk, and we would have liked to have seen the median dot for the end of next year somewhere around 2 3/4 to 3%. But otherwise, as we had been guided over the last week, nothing to quibble about.
Bob, which bond series or individual bond provides the most information right now? Is it a real yield? Is it the nominal full faith and credit? What's of the most value to Bob Michael right now?
Credit spreads. Credit spreads will tell us whether investors believe the economy is in dire shape and this was an emergency 50 basis point cut, or whether this is just a Fed a long way from neutral, perhaps, as Mohammed hinted, a meeting or two away from where they should have started the cycle, so they're starting to get towards neutral. All is well.
Okay, all is well. And yet what we saw earlier this morning was an increase in mortgage applications. What we've seen is...
Boy, that candle was crazy, wasn't it?
All of this and then some, and basically the statement only encourages...
Man, that Joe shot up
do you not see a risk
on the option chart, $3 in 2 minutes.
That we could potentially see expressed in the long end, as Mohammed was mentioning.
I'm on the sideline, man. I'm scared of this, bro. It's too crazy for me, bro.
Whoa, whoa, whoa. We're a long way away from that. We're looking at the 3-month annualized rate of core PCE running at 1.7%. So that's not inflation.
All right, bro.
There's signs of disinflation everywhere. When you look at the labor market, they talked about full employment. Well, the low in unemployment was 3.4%. A couple months ago, it was 4.3%. That's up 0.9%. You only see that when there's threat of recession. That's characteristic of that. They've highlighted to us that the neutral Fed funds rate is somewhere around 3%. That's a debate we could have for a long time, but it's nowhere near 5.25%, 5.5%. So they can start taking pressure off of businesses and households without reigniting inflation.
Bob, I know they call you Bob Michael, but you told me earlier it was Bob Michel, so I'm going to stick to Bob Michel. Bob,
Mohammed, I came to London because I thought we were going to QPR Millwall on Saturday. Now you're in New York on me?
I'll be in London tomorrow.
All right.
So Bob, speak a little bit to the revisions in the projections, and particularly unemployment. What do you make of that?
I didn't catch them. What did they do?
They pushed it up.
Yeah, I think they have to. I think they have to acknowledge that we're at a challenging time, that there are new entrants to the labor market, but those are still unemployed U.S. workers. And they have to acknowledge that we're not below 4% anymore. We're heading a little bit higher. And that's why you need the policy response to start with 50 basis points. I'm okay with that.
Yeah, but Bob, I think we've got to talk about this a little bit more. And I'm pleased we went to unemployment. Unemployment right now in America is at 4.2%. These are the Fed's projections out in 2024 year end, out to 25 and beyond. They've got projections of 4.4%, the median projection for unemployment this year. Next year, they've got it at 4.4%. Given the move we've seen over the last 12 months, Bob, how aspirational is that? How realistic is it that we just kind of pause around these levels for the next 18 months?
Well, we very well could. If we get 225s over the next two meetings and we bring rates down 100 basis points, what we know is there's still a shortage of housing. There are first-time home buyers queued up to buy homes. So bringing rates down could bring those buyers into the market. We also know that a lot of businesses don't fund themselves in the public bond market. They fund themselves through bank loans, through private credit. Those are floating rate loans. Those are anywhere starting with SOFR at 5 3/8%. You take 100 basis points off of that, that could help to stabilize things as well. Just because unemployment has headed up over the last year doesn't mean it has to keep going. It can certainly flatten out here if the Fed does its job.
Hey, Bob, appreciate catching up as always. Bob Michael there of JP Morgan Asset Management. There's a couple of moves in this market that I think are very, very interesting. We've just gone 50, and in some ways the dot plot is validating what we were pricing in this market ahead of time as well. And what you're seeing at the long end is the long bonds sell off and yields climb by 2 basis points. It's not a big move, but it's notable. We're up by 2 on 10s, on 30s we're up by 3, and at the same time we've got gold at all-time highs. What is this market sniffing out?
Well, it's sniffing out on the margins a greater inflationary risk than otherwise priced in. Look, I could make an argument about how it might mean that we're going to suddenly get run away into 70s-style inflation. That's not what it's saying. But what it is saying is that on the margins, the idea of a bigger and, frankly, a dovish 50 basis point rate cut really highlights how inflation is still back on the table, at least on the margins.
They're talking about a dual mandate imbalance. Mohammed, your impression is that it's a single mandate central bank now. And you don't think we should take our eyes off the other side of the mandate. Do you think the market's speaking to that, just on the margin, this afternoon?
I think at the margin, yes, but I do think that this is the reaction of a single mandate Fed right now, especially if you believe 2% is your inflation target.
Let's cross over to Diane Swank and bring her in of KPMG. Diane, we'd love your thoughts on the decision, and then we can get into the nuances. What do you make of the 50 instead of the 25?
This was a huge victory for Jay Powell, who really laid out at his Jackson Hole speech that he was worried about employment. And that is what this is about. And Mickey Bowman doing a dissent, Powell willing to take a dissent among the board members as opposed to among a president. That is how much he wanted this 0.5% rate cut. And I think that's very important. I think you're going to see it couched and explained within the context of several participants at the July meeting thought they were ready to go ahead and cut. So this is a bit of a catch up to that. And so that should help temper a little bit this dovish read on it. I was surprised that they kept the risk balanced, although clearly the focus is now on employment and not allowing the situation in employment to become much worse. Remember, we're at 116,000 payroll gains, 3-month moving average as of August. That's not statistically different from zero. Combined with the downward revisions we saw on August 21st, the day before Powell gave his remarks at Jackson Hole, those downward revisions, record downward revisions, even if they're not as large as they appeared because of some immigration that we're not capturing, they're still large, and it means the birth and death rate, the death rate of firms has picked up, and their small businesses aren't hiring as much as well, which could mean actually the payroll data for this year also gets revised down, and that's what they're worried about.
Diane, your work out on LinkedIn has been just hugely beneficial, a really holistic view of the U.S. economy. I have a Dow Jones Industrial Average, bottom of the pandemic, up 128%, 21% per year. I've got debt and deficit that Hal Bronner and Bernstein never dreamed of. Diane Swank, is this a Fed just dealing with our stimuli? Is this a Fed just dealing with debt and deficit to the sky?
You know, we've had everything you could possibly imagine pushed up inflation, and now we're seeing it come down despite the fact that we still have a lot of debt. So, you know, on the margin, yes, we do have high debts, and I do believe we need to deal with that at some point in time, and I don't think we have anyone who's willing to talk about it on either side of the aisle, which is another issue, and we can talk about that at a later date. But right now, we've got a Federal Reserve that's no longer buying that debt, and you've got a Federal Reserve that is seeing inflation come down despite the fact that we have high debt. And that's because on the margin, after we get past the sort of 6 months that we put a whole year budget into, from March into October 1st, you get a continuing resolution at best through year end, and you're going to get more constraints on spending, I think, as we get into 2025.
Diane, one reason why this comes as a surprise, this decision, one reason why is because they could have telegraphed this more carefully. There was no data that really moved the needle between the time when the quiet period began and now that would shift us toward 50. Why do you think there wasn't more clear communication that this was a Federal Reserve ready to cut rates by 50 basis points?
Well, frankly, I don't think that Jay Powell, by the time the blackout period hit, had the votes in his pocket to be able to do that. And I think we saw that in some of the mixed messages, even the day of the blackout period. Chris Waller, governor on the Federal Reserve, had said, you know, you'd be open to a more aggressive rate cut, but he didn't seem to be really ready to do it in September. We saw John Williams come out that same day and sort of talking about more cautious rate cuts, more of a quarter point kind of rate cut. So they didn't telegraph it because he hadn't corralled the cats, but this really does speak to the fact that he does have an extraordinary ability to actually do just that.
Let's get to this quote from Nour of Renmac, just out at the moment. Here's the issue. The balance of risks have changed. In June, most saw balanced risk to unemployment rate. Now, this has completely flipped. Most see risk to unemployed skewed to the upside. This will not be the last time we see a 50, in our opinion. Lisa, your thoughts?
This is basically what's being priced into this year. I mean, how else do they get to more than 100 basis points potentially by the end of this year? And if you think about it, it raises a lot of questions about what they are seeing that suddenly makes that such a consensus, given that we've gotten a lot of mixed messaging.
Let's head back to London and catch up with Bob Michael at JP Morgan Asset Management. Bob, I'm sitting there in cash. I've been sat here for a long time. You've been warning me for a long time that I face real reinvestment risk. The Fed's just cut 50 and I'm freaking out. I give you a call. I'm now worried about another 50 and maybe another 50 after that. What are you buying on my behalf?
We're telling clients, just get into the bond market. Just get into a general bond fund. It could be an aggregate investment grade bond fund. It could be a core plus bond fund if you're in a high tax bracket. Get into a general municipal bond fund. Yields are coming down. Yields are at this level with $6.3 trillion in cash building up and most people not liking the bond market. Some buying has brought it down here. And this money will come in because they're going to watch the return on cash go down like power windows.
I got to say, Mohammed, this goes to the point that you were making. I'd love your comments on this idea that the Fed was seeing something that made him shift his view, and what we're seeing right now is that maybe he just didn't have the votes. I'm just trying to wrap my head around what that means going forward, that maybe they're going to be even more aggressive than the market previously thought, and that maybe it is appropriate to price in even more spread compression, even more yields going lower.
So it would not surprise me if that is the market reaction. It would not surprise me at all, because the market has been conditioned to ask for more and more and gets more and more. So it wouldn't surprise me if that is what happens. I will go back to the significant dispersion in people in FOMC members' view as to what the destination looks like. And that dispersion has got to be reconciled over time. So I don't think it is as clear-cut as the market will make it seem.
Diane Swank, I got 8 ways to go here. Let's try this. You've got a wonderful reading of America away from 3 zip codes in Manhattan, the quadrants of Washington, D.C. This rate cut, how does it affect America that are not the elites, not the people enjoying NVIDIA to the moon?
Well, this is really important because the rate cuts, the short-term rate cuts, are what come through on loans that consumers take out. This is beyond the mortgage rate situation. This also helps the mortgage rate situation, obviously, but the real issue for consumers are short-term interest rates and how they are priced on their debt. Now, on the credit cards, the average credit card rate is about 25%. This is a rounding error on that. It's not going to help a lot on that. That's just incredible how high those rates are. But when you get into auto loans, when you get into other kinds of loans that consumers take and businesses, middle market through small businesses, it affects all those loans. And right now, you can imagine a lot of people are going to get some relief in terms of that. Now, the good news is there's not a lot of overhang of debt for consumers, and they can service the debt they've got. But for those lower income households that have already exhausted all of their savings and then some, this is good news. They rely on lower rates to buy used vehicles. They can't even afford to buy new vehicles anymore. That goes right up into middle income households. So that's where we'll see some movement, but it's not immediate. You're not going to see, the Fed also understands there's lags. And I think Mohammed is right about the issue of the market front running when the real message here is that this was not signaling that we're ready to cut. This is a window of opportunity to cut now, catch up on July. That's important. But this isn't a signal that they're ready to go 0.5%, sort of continuously. And the election is an uncertainty. That is not factoring into the decision today, but it is an uncertainty in terms of policy for 2025 and 2026. And that could change the trajectory for the Federal Reserve once that cloud of uncertainty regarding the election outcome in the U.S. is lifted.
Could not agree more. Dan, just one of the best as always, the clinic. Dan Swank there of KPMG. November 7th could be a very, very different meeting. If you are just joining us, welcome to the programme. 25 or 50? We got 50 from this Federal Reserve. The outlook, unclear. 10 out of 19 officials favouring lowering interest rates by at least an additional half point over the remaining 2 meetings of 2024. And the next meeting in 2024 could be very interesting if we do indeed have in hand the outcome of the presidential election. Matt Lazzetti of Deutsche Bank joins us now for more. Matt, your first reaction to this one, please, sir. We get 50.
Yeah, I think it's all about the messaging that we hear from Chair Powell about the reaction function as we look ahead. You know, as we were thinking through if they go by 50 basis points, what is the communications challenge for them? I think it's 2 things. One, they have to project confidence in the economy, positivity in the economy, so they avoid a negative confidence signal. And then 2, I think that they want to send a signal that this is not the new norm, that they're going to be ratcheting down to 25 basis point increments. And as I look at that dot plot and the skew for this year, it does seem that there's a pretty strong kind of consensus around going 25 basis points from here. I think 18 out of 19 dots showed only an expectation of 2 more 25 basis point rate cuts or less. And so I think Powell can paint this as a one-off. It was meant to right-size monetary policy to a lower inflation environment, ensure that the real rate doesn't rise too much, and to really show that kind of actions speak louder than words in providing confidence on the soft landing.
Matt Lazzetti, the 10-year real yield just printed below 1.50. To me, that's a huge signal coming out of the pandemic. What does a diminished real yield do for American business, American finance, and investment?
Look, I think we should expect that the goal of this is to keep financial conditions easy, to ensure that financial conditions don't over-tighten and put a soft landing in jeopardy. That is ultimately the legacy of Chair Powell, and I think that he took out some insurance against that today. I think that's a good outcome for the economy. Hopefully he can message it in that way, which is they have a positive outlook. This is not the starting of a 50 basis point cutting cycle. And I think if you get that, soft landing prospects improve, financial conditions ease, and we have a very good outcome for the economy.
Matt, one of the stickiest areas of inflation has been the housing market. And what we've seen there has been recently an uptick in mortgage applications, as well as just in general, some of the home lender stocks. How quickly could you see a transition from a market that is completely flat on its back, not shifting around, moving at all, to one that is robustly price discovering to the upside with people given renewed confidence by lower rates?
Yeah, you know, we got mortgage purchase applications this morning, and they did show a tick up, more driven by refinancing activity than purchase activity. It does seem to be lagging a little bit, the move in the mortgage rate so far. My own view is I think that's driven by, when you look at the University of Michigan or Conference Board, so many consumers expect rates to come down over the next year. And so that has to happen, and maybe as rate cuts happen and as mortgage rates fall further, that really does unleash activity in the housing market. That would present upside risks for the economy. You know, I think the reality is, Q2 growth was 3%. Q3 growth is tracking near 3% according to the Atlanta Fed GDP. When you look at consumer spending on a 3-month annualized rate, it's the highest that we've had since 2011. We got a robust retail sales report this week. So, you know, I think Chair Powell should present a picture where the underlying economy and fundamentals are resilient and strong here, but they were taking decisive action today to ensure that those outcomes continue.
Hey, Matt, final round before you go. Question for the chairman in this news conference. What's your number 1 question?
I think it's all about reaction function. So the fact that they went by 50 basis points today before seeing very weak outcomes for the economy will naturally raise questions in the market about what if you get a weaker jobs report? Do they go by 75 basis points or not? So I think it's all about the reaction function from here. And, you know, how does he respond to that? Does he kind of set a high bar either for another 50 basis point or even higher rate cuts?
Matt Lazzetti at Deutsche Bank. Bob Michael at JP Morgan Asset Management still with us. Bob, you love asking this one too, so I'll ask it for you. What's your question for Mike McKee in this news conference a little bit later on this afternoon?
Has the concept of an equilibrium, long-term neutral Fed funds rate expire? Do we need that anymore? Shouldn't they be talking more in terms of a real Fed funds rate, maybe minus 1% to plus 3%? I mean, for goodness sakes, in my career, I've seen the Fed funds rate at 0 and 20%. So trying to target something like that is nonsensical to me.
Hey, Bob, got to catch up as always. Bob Michael at JP Morgan Asset Management. We get 50 from the Federal Reserve. Your news conference is 5 minutes away. The price action looks like this, up 0.5% on the S&P 500. In the last hour, Lisa printing a new all-time high on the S&P.
Which really is in line with what some people were expecting, although disappointment they did not get. If you want to take a look at whether this is a Fed that can outdove market expectations, it seems like they did. And the projections going forward really highlight how this market likes to run ahead of even where Fed pricing is. Just look at this. If you take a look at Fed fund future pricing, we're actually pricing in a 4.1% Fed funds rate to end this year. So we're talking about an additional almost 100 basis points of additional cuts from here, 150 basis points of cuts, which just again points to why a dovish 50 basis point cut has made a difference in this market.
Mohammed, you alluded to this. If they go 50, the pressure will build to go 50 again. Is that what's happening?
That is what's happening, and the market loves this. And it's been the repeated conditioning of the market. Give it something, it will want more.
I look at this late in the press conference, John, when we get to the political questions. Like if I was to parachute John into the Alarian Institute of Behavioral Economics and Policy.
Would you behave?
I would behave, and the answer is there's 2 United Kingdoms out there and there's 2 Americas out there, and he has to address within his neutrality and the political debate those 2 Americas. It's not just about Bob Michael and the portfolio on Park Avenue trying to figure out what to do next.
How does he navigate some of those issues, Mohammed? How difficult is it to set policy for 2 very different experiences in this economy?
It's very difficult. It's even more difficult when politicians are shouting,
go 75.
Go 75. No, it is really difficult. What's not clear to me is if he is actually buying insurance, what is the cost of that insurance? What is the downside of buying insurance? You know, insurance is hardly ever costless. So what is the downside of having bought insurance for the economy? And that's something we'll only find out over time.
What's the cost of buying insurance for the economy, but also for the Fed and for its political independence and its reputation therein? I just wonder if it's more difficult to make the decision now on November 7th, now that you've had this initial 50 basis point rate cut, and you have a market that's now saying, yeah, you could do another one in November.
Yeah, and that was the argument all along. Start in July. Don't get yourself in this situation. But it is what it is, and they're now going to have to navigate this. I think Powell is going to be very clear. He'll say we are not impacted by political issues, just like he will say that he is blessed, to use his word, by lots of opinions from outside. But ultimately, it's what they decide in that room.
And they will get lots of opinions after this one. In just a moment, 2 minutes away, Chairman Powell will walk into that room and give us a news conference for the next 60 minutes or so. We'll take that in its entirety on Bloomberg TV and on Bloomberg Radio. Lisa, things could be very different on November 7th. We've said that repeatedly. I don't think you can overstate it. Things could be very different. The outlook for 2025 could shape up in a rather different way, dependent on what the complexion of Congress looks like, how divided things are in the nation's capital.
And whether or not we even know at that point, as Anne-Marie likes to say, whether we have a decision. It just will be interesting how much, this is the 3-part act, we get the 3rd part of the act coming up moments away, how he characterizes what this insurance policy is really for. Is this because they are seeing true weakening in a labor market that otherwise is kind of hanging in there? And that, I think, is one of the key questions.
How do you expect him to frame it? Is this a one-off mid-cycle adjustment, a wait and see, we'll regroup in November? Or is this the beginning of a one-way trip back towards what they think is neutral?
Could it be both? I mean, right? Is there's basically, can everyone have their cake and then eat it too? Because essentially you have inflation coming down and you have an economy that is in a trajectory that typically does lead to further weakening. Is it history that can actually make sense at a time?
Your future is at your fingertips. Take advantage of the flexibility and diversity of futures trading with NinjaTrader, the #1 rated futures broker. Start trading futures today.
If you're a social media manager like me, HoneyBook has tools that make getting paid so much easier. As a business owner, it's important to lean into your strengths and do the things that only you can do. And my best secret is using HoneyBook for the rest. With HoneyBook, discovery calls are booked on autopilot through lead forms. Client onboarding and offboarding is done effortlessly through automations, and their contract templates help me get paid on time and keep projects in scope. Plus, delivering an exceptional client experience keeps my clients coming back, and HoneyBook helps me do just that. First impressions matter in business. You want to make sure your social media management business looks as polished and professional as you really are. And it's easier than you think. Start a free trial so you can see for yourself.
The labor market has cooled from its formerly overheated state. Inflation has eased substantially from a peak of 7% to an estimated 2.2% as of August. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a 0.5 percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.2% in the first half of the year, and available data point to a roughly similar pace of growth this quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment fell back in the second quarter after rising strongly in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of 2% over the next few years. In the labor market, conditions have continued to cool. Payroll job gains averaged 116,000 per month over the past 3 months, a notable step down from the pace seen earlier in the year. The unemployment rate has moved up but remains low at 4.2%. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year, 0.4 higher than projected in June. Inflation has eased notably over the past 2 years, but remains above our longer-run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.2% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 2.7%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.3% this year and 2.1% next year, somewhat lower than projected in June. Thereafter, the median projection is 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. Our primary focus had been on bringing down inflation, and appropriately so. We are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our restrictive monetary policy has helped restore the balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remain well anchored. Our patient approach over the past year has paid dividends. Inflation is now much closer to our objective, and we have gained greater confidence that inflation is moving sustainably toward 2%. As inflation has declined and the labor market has cooled, the upside risks to inflation have diminished and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance, and we are attentive to the risks to both sides of our dual mandate. In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by a half percentage point to 4.75% to 5%. This recalibration of our policy stance will help maintain the strength of the economy and the labor market and will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance. We are not on any preset course. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment, as well as the changed balance of risks. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation back down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking our questions. In July, you said you weren't necessarily thinking about a 50. You didn't want to be specific, but you said you weren't thinking about a 50. The inflation data last week came out a little firmer than expected. Retail was strong, third quarter GDP running 3%. So what changed and made the committee go 50, and how do you respond to the concerns that perhaps it shows the Fed is more concerned about the labor market? And I guess, should we expect more 50s in the months ahead? And based on what should we make that call? Thank you.
So, okay, a lot of questions in there. Let me jump in. Since the last meeting, we have had a lot of data come in. We've had the two employment reports, July and August. We've also had two inflation reports, including one that came in during blackout. We had the QCEW report, which suggests that suggests that the payroll report numbers that we're getting may be artificially high and will be revised down. You know that. We've also seen anecdotal data like the Beige Book. So we took all of those and we went into blackout and we thought about what to do, and we concluded that this was the right thing for the economy, for the people that we serve, and that's how we made our decision. So that's one question. What was the second and third?
How do we make sorry, thank you, sir. How do we figure out in the months ahead, is there another 25 or 50 coming in? Based on what shall we make that call? Thank you.
Sure. So a couple things. A good place to start is the SEP, but let me start with what I said, which was that we're going to be making decisions meeting by meeting based on the incoming data, the evolving outlook, the balance of risks. If you look at the SEP, you'll see that it's a process of recalibrating our policy stance away from where we had it a year ago when inflation was high and unemployment low, to a place that's more appropriate given where we are now and where we expect to be. And that process will take place over time. There's nothing in the SEP that suggests the committee is in a rush to get this done. This process evolves over time. Of course, that's a projection. That's a baseline projection. We know, as I mentioned in my remarks, that the actual things that we do will depend on the way the economy evolves. We can go quicker if that's appropriate. We can go slower if that's appropriate. We can pause if that's appropriate. But that's what we were contemplating. I would point you to the SEP as just an assessment of where of what the committee is thinking today, what the individual members, rather, of the committee are thinking today, assuming that their particular forecasts are realized.
Go ahead, Chris.
Hi, Chris Rugaber at Associated Press. Thank you. The projections show that the Fed officials expect the Fed funds rate to still be above their estimate of long-run neutral by the end of next year. So does that suggest you see rates as restrictive for that entire period? Does that threaten the weakening of the job market that you said you'd like to avoid? Or does it suggest that maybe people see the short-run neutral as a little bit higher than thank you.
I think the way I would really characterize it is this. I think people write down their estimate, individuals do. I think every single person on the committee, if you ask them what's your level of certainty around that, they would say there's a wide range where that could fall. So I think we don't know. There are model-based approaches and empirically based approaches that estimate what the neutral rate will be at any given time. But realistically, we know it by its works. So that leaves us in a place where we expect, in the base case, to be continuing to remove restriction, and we'll be looking at the way the economy reacts to that, and that'll be guiding us in our thinking about the question that we're asking at every meeting, which is our policy stance the appropriate one? We know, if you go back, we know that the policy stance we adopted in July of 2023 came at a time when unemployment was 3.5% and inflation was 4.2%. Today, unemployment is up to 4.2%. Inflation's down to a few tenths above 2. So we know that it is time to recalibrate our policy to something that is more appropriate given the progress on inflation and on employment moving to a more sustainable level. So the balance of risks are now even. And this is the beginning of that process. I mentioned the direction of which is toward a sense of neutral. And we'll move as fast or as slow as we think is appropriate in real time. But what you have is our individual accumulation of individual estimates of what that will be in the base case.
Howard Schneider with Reuters. How close was this in terms of the decision? You do have the first dissent by a governor since 2005, I think. Was the weight clearly in favor of a 50, or was this a very close decision?
I think we had a good discussion. If you go back, I talked about this at Jackson Hole, but I didn't address the question of the size of the cut, left it open, and I think we left it open going into blackout. And so there was a lot of discussion back and forth, good diversity of division, excellent discussion today. I think there was also broad support for the decision that the committee voted on. So I would add, though, look at the SEP. All 19 of the participants wrote down multiple cuts this year, all 19. That's a big change from June, right? 7 of them wrote down 3 or more, 17 of the 19 wrote down 3 or more cuts, and 10 of the 19 wrote down 4 or more cuts. So, there is a dissent, and there's a range of views, but there's actually a lot of common ground as well.
Follow up to that, now that this is in the books, can you give us some guidance as sort of follow up to Steve on the pacing here? Would you expect this to be running every other meeting once we get into next year? For example,
we're going to take it meeting by meeting. As I mentioned, there's no sense that the committee feels it's in a rush to do this. We made a good, strong start to this, and that's really, frankly, a sign of our confidence. Confidence that inflation is coming down toward 2% on a sustainable basis. That gives us the ability. We can, make a good, strong start, but. And I'm very pleased that we did. To me, the logic of this, both from an economic standpoint and also from a risk management standpoint, was clear. But I think we're going to go carefully, meeting by meeting, and make our decisions as we go.
Gina.
Hi, Chair Powell. Gina Smilik at the New York Times. Thanks for taking our questions. You and your colleagues in your economic projections today see the unemployment rate climbing to 4.4% and staying there. Obviously, historically, when the unemployment rate climbs that much over a relatively short period of time, it doesn't typically just stop. It continues increasing. And so I wonder if you can walk us through why you see the labor market stabilizing, sort of what's the mechanism there, and what do you see as the risks?
So, again, the labor market is actually in solid condition, and our intention with our policy move today is to keep it there. You can say that about the whole economy. The U.S. economy is in good shape. It's growing at a solid pace. Inflation is coming down. The labor market is in a strong pace. We want to keep it there. That's what we're doing.
Sorry, Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, does today's action constitute a catch-up in action given recent substantial revisions to the employment data? Or is this larger than typical rate cut a function of the elevated nominal level of the policy rate such that an accelerated cadence could be expected to continue?
Okay. Multiple questions there. So I would say we don't think we're behind. We do not think we think this is timely. But I think you can take this as a sign of our commitment not to get behind. So it's a strong move. Sorry, your other question was?
Well, is this about what happened in the employment data between this meeting and the last meeting, or is this about the level of the funds rate, the high nominal level of the funds rate relative to what might be expected if you're trying to maintain equilibrium?
So I think it's about, we come into this with a policy position that was put in place, as you know, I mentioned in July of 2023, which was a time of high inflation and very low unemployment. We've been very patient about reducing the policy rate. We've waited. Other central banks around the world have cut, many of them several times. We've waited, and I think that patience has really paid dividends in the form of our confidence that inflation is moving sustainably under 2%. So I think that is what enables us to take this strong move today. I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is look at the SEP. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level. And we're moving at the pace that we think is appropriate given developments in the economy in the base case. The economy can develop in a way that would cause us to go faster or slower, but that's what the base case says.
And if I could follow up on the balance sheet. In 2019, when you did the mid-cycle adjustment, you ceased the balance sheet runoff. With a larger cut today, should there be any signal inferred about how the committee would approach end state on the balance sheet policy?
So in the current situation, reserves have really been stable. They haven't come down. So reserves are still abundant and expected to remain so for some time. As you know, the shrinkage in our balance sheet has really come out of the overnight RRP. So I think what that tells you is we're not thinking about stopping runoff because of this at all. We know that these two things can happen side by side. In a sense, they're both a form of normalization. And so for a time, you can have the balance sheet shrinking, but also be cutting rates.
Colby.
Thank you. Colby Smith with the Financial Times. Just following up on Gina's question on rising unemployment, is it your view that this is just a function of a normalizing labor market amid improved supply, or is there anything to suggest that something more concerning perhaps is taking place here, given that other metrics of labor demand have softened too? And I guess in direct follow-up to Gina is, why should we not expect a further deterioration in labor market conditions if policy is still restrictive?
So I think what we're seeing is clearly labor market conditions have cooled off by any measure, as I talked about in Jackson Hole. And but they're still at a level. The level of those conditions is actually pretty close to what I would call maximum employment. So you're close to mandate, maybe at mandate on that. So what's driving it? Clearly, payroll job creation has moved down over the last few months, and this bears watching. By many other measures, the labor market has returned to or below 2019 levels, which was a very good, strong labor market, but this is more sort of 2018-17. So the labor market bears close watching, and we'll be giving it that. But ultimately, we believe, with an appropriate recalibration of our policy, that we can continue to see the economy growing, and that will support the labor market. In the meantime, if you look at the growth in economic activity data, the retail sales data that we just got, second quarter GDP, all of this indicates an economy that is still growing at a solid pace. So that should also support the labor market over time. So, but again, it bears watching, and we're watching.
And just on the point about starting to see rising layoffs, if that were to happen, wouldn't the committee already be too late in terms of avoiding a recession?
So our plan, of course, has been to begin to recalibrate. And as you know, we're not seeing rising claims. We're not seeing rising layoffs. We're not seeing that, and we're not hearing that from companies that that's something that's getting ready to happen. So we're not waiting for that, because there is thinking that the time to support the labor market is when it's strong, and not when you begin to see the layoffs. There's some lore on that. So that's the situation we're in. We have, in fact, begun the cutting cycle now, and we'll be watching, and that'll be one of the factors that we consider. Of course, we're going to look at the totality of the data as we make these decisions meeting by meeting.
Michael McKee with Bloomberg TV and Radio. To follow up on that, what would constitute for you and the committee a deterioration in the labor market? You're pricing in basically by the end of next year 200 basis points of cuts just to maintain a higher unemployment rate. Would you be moving to a more preemptive monetary policy style rather than, as you did with inflation, waiting until the data gave you a signal?
No, we're going to be watching all of the data, right? So if, as I mentioned in my remarks, if the labor market were to slow unexpectedly, then we have the ability to react to that by cutting faster. We're also going to be looking at our other mandate, though. We have greater confidence now that inflation is moving down to 2%, but at the same time, our plan is that we will be at 2%, over time. So. And policy, we think, is still restrictive, so that should still be happening.
I'm just curious as to how sensitive you'll be to the labor market, since you forecast we are going to see higher unemployment, and it is going to take a significant amount of monetary easing to just maintain it.
So, what I would say is we don't think we need to see further loosening in labor market conditions to get inflation down to 2%. But we have a dual mandate.
Your competitors will wish they had known about Vibe. With Vibe, you can launch targeted TV and streaming ad campaigns using our powerful platform that combines simplicity with deep market insight. Not only can you choose from over 500 channels and apps, but you can also tailor your reach from nationwide audiences to local viewers with precision. Getting started with Vibe is incredibly easy. Just log in, set up your campaign by selecting your audience demographics, and decide where you want your ads to appear. Tell us your budget and watch as Vibe crafts a campaign that resonates with your audience and fits your financial plan. Spend your first $500 on advertising with us, and we'll give you an additional $500 in ad credit. That's right, double the impact for your initial investment. In just a few quick steps, you'll have everything you need to make your brand a star on the screen. Don't just advertise. Dominate with Vibe.
I chose Wix for my business because of its massive scope for functionality and freedom of creation. Being able to integrate and change and develop at my own pace. I offer a range of products and services. To manage it all from one place is essential. It gave me time back in my day to get going on actual projects. It really just made everything feel more achievable.
Sustainable level is, so we feel good about that. Vacancies over, per unemployed is back to what is still a very strong level. It's not as high as it was. That number reached 2 to 1, 2 vacancies for every unemployed person, as measured. It's now below around 1, but that's still a very good number, I would say. Quits have come back down to normal levels. I mean, I could go on and on. There are many, many employment indicators. What do they say? They say this is still a solid labor market. The question isn't the level. The question is that there has been change, particularly over the last few months. And, so what we say is as the risks, the upside risks to inflation have really come down, the downside risks to employment have increased. And because we have been patient and held our fire on cutting while inflation has come down, I think we're now in a very good position to manage the risks to both of our goals.
And what do you expect to learn between now and November that will help inform the scale of the cut at the next meeting?
More data, the usual. Don't look for anything else. We'll see another labor report. We'll see another jobs report. I think we get a second jobs report on the day of the meeting, I think. Or no, on the Friday before the meeting. And inflation data. We'll get all this data. We'll be watching. It's always a question of look at the incoming data and ask what are the implications of that data for the evolving outlook and the balance of risks, and then go through our process and think what's the right thing to do. Is policy where we want it to be to foster the achievement of our goals over time? So that's what it is, and that's what we'll be doing.
Hi, Chair Powell. Neil Irwin with Axios. We've only been running a little above 100,000 jobs a month on payrolls the last 3 months. Do you view that level of job creation as worrying or alarming, or would you be content if we were to kind of stick at that level? And relatedly, one of the welcome trends of the last couple of years has been labor market steam coming out through job openings falling rather than job losses. Do you think that trend has further to run, or do you see risk that further labor market cooling will have to come through job losses?
So on the job creation, it depends on the inflows, right? So if you're having millions of people come into the labor force, and you're creating 100,000 jobs, you're going to see unemployment go up. So it really depends on what's the trend underlying the volatility of people coming into the country. We understand there's been quite an influx across the borders, and that has actually been one of the things that's allowed unemployment rate to rise. And the other thing is just the slower hiring rate, which is something we also watch carefully. So it does depend on what's happening on the supply side. And on the beverage curve question, yes. So we all felt on the committee, not all, but I think everyone on the committee felt that job openings were so elevated that they could fall a long way before you hit the part of the curve where job openings turned into higher unemployment, job loss. And yes, I think we are. It's hard to know that you can't know these things with great precision, but certainly it appears that we're very close to that point, if not at it, so that further declines in job openings will translate more directly into unemployment. But it's been a great ride down. I mean, we've seen a lot of tightness come out of the labor market in that form without it resulting in lower employment.
Thanks, Chair Powell. Edward Lawrence, Fox Business. So we've heard some speculation that you may be going with the federal funds rate to 3.5%, maybe under 4%. And there's basically an entire generation that has experienced zero or near zero federal funds rate. Now, some think we're heading in that direction again. What's the likelihood that cheap money is now the norm?
So this is a question. You mean after we get through all of this? It's just a great question that we can only speculate about. intuitively, many people anyway would say we're probably not going back to that era where there were trillions of dollars of sovereign bonds trading at negative rates, long-term bonds trading at negative rates, and it looked like the neutral rate might even be negative. So people were issuing debt at negative rates. It seems that's so far away now. My own sense is that we're not going back to that. But honestly, we're going to find out. But it feels to me and that the neutral rate is probably significantly higher than it was back then. How high is it? I just don't think we know. We only know it by its works.
And one more. How do you respond to the criticism that will likely come that a deeper rate cut now before the election has some political motivations?
Yeah, so this is my fourth presidential election at the Fed, and it's always the same. We're always going into this meeting in particular and asking what's the right thing to do for the people we serve, and we do that, and we make a decision as a group, and then we announce it, and that's always what it is. It's never about anything else. Nothing else is discussed, and I would also point out that the things that we do really affect economic conditions for the most part with a lag. So nonetheless, this is what we do. Our job is to support the economy on behalf of the American people. And if we get it right, this will benefit the American people significantly. So this really concentrates the mind. And it's something we all take very, very seriously. We don't put up any other filters. I think if you start doing that, I don't know where you stop. And so we just don't do that.
Jolene. Thank you, Chair Powell. I'm Jolene Kent with CBS News. My first question is, very simply, what message are you trying to send American consumers, the American people, with this unusually large rate cut?
I would just say that, the U.S. economy is in a good place, and our decision today is designed to keep it there. More specifically, the economy is growing at a solid pace. Inflation is coming down closer to our 2% objective over time. And the labor market is still in solid shape. So our intention is really to maintain the strength that we currently see in the U.S. economy. And we'll do that by returning rates from their high level, which has really been, the purpose of which has been to get inflation under control. We're going to move those down over time to a more normal level. Over time.
Just a quick follow-up to that. Listening to you talk about inflation moving meaningfully down to 2%, is the Federal Reserve effectively declaring a decisive victory over inflation and rising prices?
No, we're not. So inflation, what we say is we want inflation, the goal is to have inflation move down to 2% on a sustainable basis. And, we're not really, we're close, but we're not really at 2%. And I think we're going to want to see it be, around 2% and close to 2% for some time. But we're certainly not we're not saying mission accomplished or anything like that. But I have to say, though, we're encouraged by the progress that we have made.
Hi, Katerina Saraiva with Bloomberg News. I just would love to know kind of how the committee is thinking about the persistence we've seen in housing inflation. Do you think you can return to 2% with housing inflation where it is? Yeah.
So housing inflation is the one piece that is kind of dragging a bit, if I can say. We know that market rents are doing what we would want them to do, which is to be moving up at relatively low levels. But they're not rolling over. The leases that are rolling over are not coming down as much, and OER is coming in high. So, it's been slower than we expected. I think we now understand that it's going to take some time for those lower market rents to get into this. But, the direction of travel is clear, and as long as market rents remain, relatively low inflation over time, that will show up. Just the time it's taking now, several years rather than just one or two cycles of annual lease renewals. So I think we understand that now, but I don't think the outcome is in doubt. Again, as long as market rents remain under control, the outcome is not in doubt. So I would say, it's the rest of the portfolio, or of the elements that go into core PCE inflation have behaved pretty well. You know, they all have some volatility. We will get down to 2% inflation, I believe, and I believe that ultimately we'll get what we need to get out of the housing services piece too.
Some of your colleagues have expressed concern that with starting to cut rates, you could reignite demand in housing and see prices go up even more. You know, what's the likelihood of that, and how would you react to that?
So the housing market, it's hard to game that out. The housing market is in part frozen because of lock-in with low rates. People don't want to sell their home, so because they have a very low mortgage, it'd be quite expensive to refinance. As rates come down, people will start to move more, and that's probably beginning to happen already. But remember, when that happens, you've got a seller, but you've also got a new buyer in many cases. So it's not, obvious how much additional demand that would make. I mean, the real issue with housing is that we have had and are on track to continue to have not enough housing. And so it's going to be challenging. It's hard to find, to zone lots that are in places where people want to live. It's all of the aspects of housing are more and more difficult. And, where are we going to get the supply? And this is not something that the Fed can really fix. But I think as we normalize rates, you'll see the housing market normalize. And, I mean, ultimately, by getting inflation broadly down and getting those rates normalized and getting the housing cycle normalized, that's the best thing we can do for householders. And then the supply question will have to be dealt with by the market and also by government.
Victoria. Hi, Victoria Guida with Politico. Just following up on some of the labor market talk earlier, monetary policy operates with long and variable lags, and I'm wondering how much you see being able to keep the unemployment rate from raising too much comes from the fact that you're starting to act now, and that's going to give people more room to run versus just the labor market is strong. And then also, if I could, following up on Nick's question, do you see today's 50 basis point move as partially a response to the fact that you didn't cut in July, and that sort of gets you to the same place?
So you're right about lags, but I would just point to the overall economy. You have an economy that is growing at a solid pace. If you look at forecasters or talk to companies, they'll say that they think 2025 should be a good year too. So there's no sense that the U.S. economy is basically fine. If you talk to market participants, I mean, business people who are actually out there doing business. So I think our move is timely. I do, and as I said, you can see our 50 basis point move as a commitment to make sure that we don't fall behind. So you're really asking about your second question. You're asking about July, and I guess if you ask, if we'd gotten the July report before the meeting, would we have cut? We might well have. We didn't make that decision, but we might well have. I think that's not. That doesn't really answer the question that we ask ourselves, which is let's look. When at this meeting we're looking back to the July employment report, the August employment report, the two CPI reports, one of which came, of course, during blackout. And all of the other things that I mentioned. We're looking at all of those things, and we're asking ourselves, what's the policy stance we need to move to? It's clear that we literally, everyone on the committee agreed that it's time to move. It's just how fast do you go, and what do you think about the path forward? So this decision we made today had broad support on the committee, and I've discussed the path ahead.
Thank you, Chair Powell. Elizabeth Schulze with ABC News. Mortgage rates have already been dropping in anticipation of this announcement. How much more should borrowers expect those rates to drop over the next year?
Very hard for me to say. That's from our standpoint. I can't really speak to mortgage rates. I will say, that'll depend on how the economy evolves. Our intention, though, is we think that our policy was appropriately restrictive. We think that it's time to begin the process of recalibrating it to a level that's more neutral rather than restrictive. We expect that process to take some time. as you can see in the projections that we released today. And if things work out according to that forecast, other rates in the economy will come down as well. However, the rate at which those things happen will really depend on how the economy performs. We can't look a year ahead and know what the economy is going to be doing.
What's your message to households who are frustrated that home prices have still stayed so high as rates have been high? What do you say to those households?
Well, what I can say to the public is that we had a burst of inflation. Many other countries around the world had a similar burst of inflation, and when that happens, part of the answer is that we raise interest rates in order to cool the economy off, in order to reduce inflationary pressures. It's not something that people experience as pleasant, but at the end, what you get is low inflation restored, price stability restored. And a good definition of price stability is that people in their daily decisions, they're not thinking about inflation anymore. That's where everyone wants to be, is back to what's inflation. We just keep it low, keep it stable. We're restoring that. So what we're going through now really it will benefit people over a long period of time. Price stability benefits everybody over a long period of time just by virtue of the fact that they don't have to deal with inflation. So that's what's been going on, and I think we've made real progress. We don't tell people how to think about the economy, of course, and of course people are experiencing high prices as opposed to high inflation, and we understand that's painful.
Hi, Chair Powell. Greg Robb from MarketWatch.com. I was wondering if you could go through, you said just at the beginning that coming into the blackout, there was like an open thought of 25 or 50. The Fed could move either 25 or 50. I would sort of argue that when we had those two last speeches by Governor Waller and New York Fed President John Williams, that they were sort of saying that maybe a gradual approach was going to win the day. I mean, I sort of want to ask a 7-part question about this, but I mean, would you have cut rates by 50 basis points if the market had been pricing in like low odds of a 50-point move like they were last Wednesday? After the CPI number came out, it was a really small probability of a 50-point cut. Does that play in your consideration at all? Just talk a little bit about that. Thank you.
We're always going to try to do what we think is the right thing for the economy at that time. That's what we'll do. And that's what we did today.
Thank you, Chair Powell. Simon Rabinovich with The Economist. You've mentioned how closely you're watching the labor market, but you also noted that payroll numbers have been a little bit less reliable lately because of the big downward revisions. Does that put your focus overwhelmingly on the unemployment rate? And given the SEP projection of 4.4 basically being the peak in the cycle, would going above that be the kind of thing that would trigger another 50 basis point cut?
So we will continue to look at that broad array of labor market data, including the payroll numbers. We're not discarding those. I mean, we'll certainly look at those, but we will mentally tend to adjust them based on the QCEW adjustment, which you referred to. There isn't a bright line. It will be, the unemployment rate's very important, of course, but there isn't a single statistic or a single bright line over which that might move that would dictate one thing or another. We'll look at each meeting, we'll look at all the data on inflation, economic activity, and the labor market, and we'll make decisions about is our policy stance where it needs to be to foster over the medium term our mandate goals. Yeah, so I can't say we have a bright line in mind.
Matt Egan.
Thanks, Chair Powell. Matt Egan from CNN. I know that you discussed earlier how the Fed does whatever the right thing is and nothing else factors in. But, in general, can you talk about whether or not you believe a sitting U.S. president should have a say in Fed decisions on interest rates? Because that's something that former President Trump, who obviously appointed you, has previously suggested. And I know the Fed is designed to be independent, but why? Can you tell the public why you view that so importantly?
Sure. So countries that are democracies around the world, countries that are sort of like the United States, all have what are called independent central banks. And the reason is that people have found over time that insulating the central bank from direct control by political authorities avoids making monetary policy in a way that favors maybe people who are in office as opposed to people who are not in office. So that's the idea, is that, and I think the data are clear that countries that have independent central banks, they get lower inflation. And so we do our work to serve all Americans. We're not serving any politician, any political figure, any cause, any issue, nothing. It's just maximum employment and price stability on behalf of all Americans. And that's how the other central banks are set up too. It's a good institutional arrangement, which has been good for the public. And I hope and strongly believe that it will, continue.
Kyle Campbell for American Banker. Thanks for taking the questions, Chair Powell. A couple regulatory developments in the past week that I want to ask you about. First, last week, Vice Chair for Supervision, Michael Barr, outlined his views for the changes to the Basel III Endgame. I'm wondering if you are in alignment with him on what those changes should be, if those have support on the board in a broad way that you're looking for, and if you think the other agencies are also fully on board with that approach. And then yesterday, other banking regulators.
You know what? Hold the second question.
Okay, sure.
Let me we'll give you the second question. So, the answer to your question is that yes, those changes were negotiated between the agencies with my support and with my involvement, with the idea that we were going to repropose the changes that Vice Chair Barr talked about, and then take comment on them. So yes, that is, that's happening with my support.
And then is there a date for that?
That's not a final proposal, though. You understand? We're putting them out for comment. We're going to take comment and make appropriate changes. We don't have a calendar date for that. And as for the other agencies, the idea is that we're all moving together. We're not moving separately. So that I don't know exactly where that is, but the idea is that we will move as a group to put this again out for comment, and then it'll come. The comments will come back 60 days later, and we'll dive into them, and we'll try to bring this to a conclusion sometime in the first half of next year.
Right. And then yesterday there were merger reform finalizations from the other bank regulators. What does the Fed have to do to align itself on merger?
I would bounce that question to Vice Chair Barr. It's a good question, but I don't have that today. Thanks.
Jennifer for the last question. Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said earlier that the decision today reflects with appropriate recalibration strength in the labor market that can be maintained in the context of moderate growth. Even though the policy statement says you view the risks to inflation and job growth as roughly balanced. Given what you've said, though, today, I'm curious, are you more worried about the job market and growth than inflation? Are they not roughly balanced?
No, I think, and we think they are now roughly balanced. So if you go back for a long time, the risks were on inflation. We had a historically tight labor market, historically tight. There was a severe labor shortage. So very hot labor market, and we had inflation way above target. So, that said to us, concentrate on inflation, and we did for a while, and we kept at that. The stance that we put in place 14 months ago was a stance that was focused on bringing down inflation. Part of bringing down inflation, though, is cooling off the economy and a little bit cooling off the labor market. You now have a cooler labor market in part because of our activities. So what that tells you is it's time to change our stance. So we did that. The sense of the change in the stance is that we're recalibrating our policy over time to a stance that will be more neutral. And today I think we made a good, strong start on that. I think it was the right decision, and I think it should send a signal that that we're committed to coming up with a good outcome here.
Is the economy more vulnerable to a shock now that could tip it into recession?
I don't think so. I don't. As I look, well, let me look at it this way. I don't see anything in the economy right now that suggests that the likelihood of a recession, of a downturn is elevated. Okay, I don't see that. You see growth at a solid rate. You see inflation coming down, and you see a labor market that's still at very solid levels. So I don't really see that. No, thank you.
That wraps up a news conference that probably should have wrapped up 15 minutes ago. Live from New York City this afternoon. Good afternoon. For our audience worldwide, welcome to the program, a special edition of Bloomberg Surveillance on a Federal Reserve decision. The decision as follows: a 50 basis point cut with a sprinkle of dissent. Your equity market on the S&P 500 still just about firmer, but rolling over in that news conference. We're now firmer by just 0.25%. On the Russell, still elevated, up by more than 1 full percentage point. Straight out of the gate in that news conference, framing policy recalibration, something he said multiple times, a process that evolves over time. Take a listen to what the chairman had to say on the path forward.
I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is, look at the SEP. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level, and we're moving at the pace that we think is appropriate.
Recalibration on repeat. Lisa, looking forward, meeting by meeting, this is not the new pace. That's something he put some weight on, some emphasis in that news conference.
And if you were basically judging his news conference based on the stock reaction, there was a little wobble after that statement, and even more of a wobble after he really addressed the idea of a neutral rate. He called it a sense of neutral, whatever that may be, and he said that my own sense is we're not going back to that Nehru time or that negative rate, very low rate time. Neutral rate is probably much higher. You saw a reaction there, but then people shook it off and said, hey, he's got our back.
I look, John, I strapped a Fibonacci across this, and from where we were to the midpoint of the pandemic low is 2 7/8. He is correct. It's just a nudge in the distance to travel just to get back to the midpoint, call it normal. It's a lot longer than the jawboning in the press conference that we just saw.
We're lucky to have Mohammed alongside us. He won't say mission accomplished. He refused to say it in this news conference, but we've got to ask, isn't it implied? Listen to this. The labour market conditions are pretty close to maximum employment. Retail sales, GDP show the economy is growing at a solid pace. We're not seeing rising layoffs or hearing it from companies. It's time to support the labour market when it's strong. That's what we're trying to do. Is that mission accomplished? Isn't it implied?
Yeah, I mean, Jason Furman put it as well as anybody can when he said, if you look at the projection, and now if you listen to the statement, it is, and I'm quoting him, just about the closest thing to mission accomplished banner that you can imagine them unfurling. So I think it is. The hard thing for Powell is that we're not just recalibrating policy, we're recalibrating what we mean by a 50 basis point cut. You don't start a 50 basis point cycle with a 50 basis point cut and say at the same time the economy is in a good place. And that's what he had to navigate all the time. If the economy is in a good place, why are you starting with 50 basis points? And it was harder for him to reconcile the two because he didn't want to acknowledge that keeping rates unchanged in July was a mistake. So that's the tension that played throughout the press conference.
He did mention that if they had that jobs report before that meeting in July, that maybe they would have gone 25 at that meeting. What did you make of that?
I made of that this idea that what does he mean about the totality of data? And he didn't talk about.
And how would you rate your manager? Get the truth anonymously with SurveyMonkey. Anyone?
About what he was looking for and how much he seems to be reconciling something. He didn't have a really clear view on that. What is the data we're looking at now? Is it basically revisions to the jobs numbers that we're getting, as well as potentially the beige book?
You've said this a few times, revisions. Seems to be more weight now in revisions. And I think over the last few news conferences now, he's basically said whatever payrolls is, He thinks it's overstating jobs growth in this country.
Which has been just the truth over the past couple of months and frankly more than a year. Typically when you get a weakening labor market, the data that you get initially is stronger than what you get on the revisions downward. But just to build on the idea of mission accomplished, he kept saying that the only reason he could really make a commitment to 50 basis points is we are committed to coming up with a good outcome. He came up with lots of, he went to the thesaurus about soft landing, but that was really where he was heading.
Joining us now to discuss to continue the conversation, Bill Dudley, the former New York Fed president, and Bloomberg economics senior advisor. Bill, in your piece before this decision on Bloomberg Opinion, you said the Fed should go big now. I think it will. It did. What did you think of what you heard this afternoon?
It's pretty much what I was expecting, in the sense that one of the issues that Powell had is how do you do 50 without scaring people that you know something bad about the economy. And I think he did that very well. He basically said, we're doing this because the news is good. We've made progress on inflation, as opposed to we're doing this because the news is bad. So I thought it was a very, he's providing reassurance to people that the Fed thinks that they've got it. Also, when he's asked about, the SOM rule and the risk that the unemployment rate could go up by quite a bit more, pretty reassuring on that. Thinks that the labor market can stabilize close to where we are today, and that's really hugely important because, if the labor market doesn't stabilize, then we will have a mild recession, and then the Fed will have to ease a lot more. So I thought the general tone of the press conference and the statement was, we've got that. We've got it.
Bill, congratulations. Your essay today, you think you are one of the Fed whisperers everybody's talking about out there right now. Bill Dudley, I look at where we are and where we're heading, and it simply comes down to the strength of the American economy. Forgetting about the theater of recession, where does GDP settle? Whether real GDP or nominal GDP, how do you envision that in a year or even 2 years?
I think if you look at the Fed's forecast and look at how that growth affects the unemployment rate, the Fed thinks that, growth in the medium term is going to be 2%, 2% plus at an annual average rate. So, and that's sort of what we're doing right now. So, the Fed's got a sort of soft landing in place. If the economy continues to grow at the same pace as it's doing right now, the unemployment rate will stay relatively stable. You saw in the summary of economic projections, the Fed shows a very modest further increase in the unemployment rate from 4.2 today to 4.4%, but nothing beyond that. So it's sort of a soft, if you look at their forecast, it's a soft landing kind of story, and I hope they can pull it off.
Right now, the stock market and the bond market are trying to understand what the reaction function of the Federal Reserve actually is and to which data they're going to look at. It seemed like there was a renewed focus on both jobs revisions as well as the beige book, which was the input to potentially some of the heavier weight on 50 basis points. Do you view that now as sort of these data points as taking on outsized importance?
I think they are more focused on the labor market because there has been deterioration in the labor market. I think they're much more confident that inflation is going to continue to come down because they've seen, more slack in the economy and the labor market. They've seen, deflation progress that we've already had. They've seen wage inflation moderating. So I think their concerns are very much on the labor market side. So when I'm looking at the economic data right now, I'm really focused on the labor market data, and that will determine whether we just continue at a relatively modest pace after this of 25 basis point reductions, which is essentially what was implied in the summary of economic projections, or whether they'll become more concerned about downside risk, and then we'll have to throw in a few 50s.
Bill, congratulations both on what you said they should do and what you said they would do. And part of your argument was on the unemployment rate. So I want to go back to that. The revision up to 4.4% by the end of this year stays at 4.4% at the end of 2025. Are you comfortable that we can stabilize here without the tipping points that you were so worried about?
We're going to find out over the next year. I mean, the SOM rule is a very simple, tells a very simple story. When the unemployment rises beyond a certain threshold, the next stop is a full-blown recession. The question is, what's the right threshold? Historically, the SOM rule threshold has been a 0.5 point rise in the unemployment rate on a 3-month moving average basis over a 12-month period, and we've already pierced that threshold. So you have to believe that there is some risk here. Paul was asked about the risk, and downside risk to the labor market, and he sort of, mostly dismissed that. But I do think that I actually do think the risks are, maybe at best they're balanced. But I would actually be more concerned about the downside risk to the labor market now than the upside risk to inflation.
Bill, you'll always find a politician that's unhappy. I've found one. Senator Warren. This cut in interest rates is yet another acknowledgement that Powell waited too long to reduce interest rates. I do think the politics are relevant here. November 7th will be the next meeting. We might have a decision in hand by the American public as to who they'd like the next president of the United States to be. We might know the makeup of Congress as well. We might have a better idea of what policy looks like in 2025. Bill, you've lived this. You were on the FOMC back in 2016, I believe. Can you walk me through your experience back then and whether the same applies this time around?
I would be very surprised if the election outcome affected what the Fed does over the near term, because, an election outcome is one thing, but what the incoming president will be able to do with, a closely divided Congress remains very uncertain. And so I think the Fed reacts to the world as it is, as opposed to speculates about how the world could be. So I would be very surprised if the Fed doesn't cut rates at the November meeting. I mean, if they don't cut rates at the November meeting, it's because the economy is bounced back and very strong, or the inflation news is, really bad between now and then. And that's not something I expect at this point. I don't think that Powell expects it. I think, the odds of a 25 basis point rate cut in November are very, very high. And if the economy shows, more weakness, then maybe even 50 basis points.
Hey, Bill, appreciate it as always. Bill Dudley of Bloomberg Opinion. The Fed should go big now. I think it will. It did. It did about an hour and 30 minutes ago. Let's bring in Michael McKee. He was in the news conference. Mike McKee, I want your thoughts on that press conference, where there was a little bit of tension for you. How did you walk out of this one?
Well, I don't think there was a huge amount of tension, except for the fact that, as you were just talking about with Bill Dudley, the idea that there is probably more risk to the Labor Department, to the labor market, than the Fed is letting on. And that's the concern. And to get to my question that Lisa mentioned, the Fed was data dependent until they were confident that inflation was going to be down to target. But how can they be data dependent on the unemployment rate? We don't know what it's going to be. And as Bill suggested, it could go up rapidly. Do we get a rapid response then, especially since policy works with a lag? It's a little unclear what their reaction function is going to be going forward. Mike,
looking forward to catching up with you tomorrow. Lots to talk about. Plenty more data just in the next week or so. Equities right now on the S&P, Lisa, firmer by 0.4%. The outperformance on the small caps, as you might expect.
Yeah, and the Fed basically gave this market what it was looking for, and then some. A question now of just how much this market has moved ahead of what the Fed has said. Mohammed, I would love your thoughts on what the new data dependency actually is, given the fact that people are looking for a litmus test to understand what the reaction function is of a Fed that kind of is playing with what they get, which is the same lack of clarity that we have.
Yeah, I think the data dependence all comes down to the labor market, and he went through in detail a number of indicators he looks at. And when he says the totality of the data, I think he really means it when it comes to the labor market. Lisa, I'm surprised you haven't picked up on the fixed income market and what has happened to treasuries, that they're now higher on the day. There's been quite a move. When the statement was announced, the 10-year went down to 364. It's currently trading at 370.
It's up 6 basis points.
It's up 6 basis points.
What do you think that is?
I think that there is some, and the curve has steepened. 2 stands are now 9 basis points. I think there is some concern as what does it mean longer term for inflation. That's the only thing I can think of. But the action has been really interesting. And once again, you end up in a different place after the press conference than you were after the statement.
Yes. No question about that. I think of David Kelly at J.P. Morgan. You know, John, he's been very good about a vector of non-farm payrolls that gets you to a negative statistic. 3-month moving average, about 116,000. Nobody's modeling in here if this job economy, as Anna Wong talks about, continues to deteriorate.
So what are we saying here, Mohammed? We're willing to accept 3, the high 2s, or we're worried about going back to 3.5, pushing 4? What's the story here?
So we cannot answer that story without bringing in fiscal policy, without bringing in structural reforms. I mean, that's the trap we have all fallen into, that we still think of the Fed as the only game in town, but there's other things happening that speak to what is that rate, and that's why the range is so wide.
You brought this up, actually, when Jay Powell said this. Over time, and we're going to get down to 2% over time. It raises this question, especially as he talks about not mission accomplished, but sort of, wish and a wash-blished. But this idea that maybe we could end up with some
I'm not going to ask you to say that again.
Please don't ever do that again.
I won't.
No, but this idea that, he's so excited about the idea of a soft landing that it's okay for it to take a number of years to get back to that 2% target.
And that's in the projections. I mean, I have him in front of me. He said core PCE right now is 2.7. They're projected at 2.6 at the end of this year, 2.2 at the end of next year, and 2 by 2026. We've basically pushed back the target.
I like what you said about mission accomplished, and it's this terror of getting this wrong, whether you're a governor, a president, whether you're the chairman. Jason Furman out teaching Act 10 up at Harvard, and he was lectured by his daughter, John. We got a tweet out from Jason Furman where his daughter walked in and said to Professor Furman, "You were wrong." There's a lot of that going on right now.
A lot of people were wrong. I think we should point this out. The market was priced for something closer to 50 than 25. The overwhelming majority of economists in our survey, and we surveyed more than 100, not even 10% of them saw 50. So shout out Mike Ferroli over at JP Morgan, one of the very few, together with Anna Wong, I believe, over at Bloomberg Economics, who were looking for that 50 today.
Yeah, Deutsche Bank actually did an informal survey also that they put out today, and something like 61%, roughly, plus or minus 0.5%, came out saying that it was 25 basis points. So this really was kind of on the back foot.
I kept it quiet. Nobody cares what I think, but the fact is I was wrong.
Jeff Rosenberg of BlackRock joins us now for more. He wasn't wrong. He's been waiting patiently to give us his views on this. Jeff, let's talk about the bond market, and you can throw in your thoughts on this Federal Reserve decision, the projections in the news conference as well. The bond market's selling off. The 30-year is up 7 basis points. The 10-year is up 6. What do you think that signals, Jeff?
Yeah, I think the important point here is that there's the action and the 50 basis points, and then there's the expectation and what was priced in. And so while the bond market was leaning towards the 50 basis points, it was really more about that segment, Jonathan, of the press conference that you highlighted. I had it written in my notes as well. The interchange where Powell said, don't take that 50 basis points as the new, pace. And he pushed back against, this is going to be followed by, you got several questions on more 50s. The problem, and I think to answer a bit of Mohammed's question, your question to Mohammed in that interchange, is that the bond market was pricing in more subsequent 50s, and into 2025 still is pricing in bigger increases than what you're getting in the S&P. And Powell in the press conference really pushed back against that. So I think you have two things going on. I'm very amenable to Mohammed and Lisa's comments that maybe this is a little bit of a sign of inflation and some of those concerns, what you're seeing in gold. But it's also, I think, in the immediacy, this is a little bit disappointing relative to what's been built up in bond expectations. And that, from a broader perspective, is really an important point from an investment perspective that you can have. Here's the headline. Fed cuts interest rates by 50 basis points, and the bond market returns are going to be negative today. So it's not just, the action. I can anticipate, the Fed's cutting rates. It's time to back up the truck in terms of duration. The problem is it's also a lot in the price. So they've got to over-deliver, and they didn't do that relative to bond expectations. And that's why I think you're seeing a little bit of that disappointment out of fixed income markets and their read on today's decision.
Jeff, Mohammed scolded me because, frankly, I wasn't paying enough attention to the bond market. The bond market is speaking, and the 10-year note is speaking. And what it's saying is it at least has a higher yield. But we are speaking to the bond market right now. Jeff Rosenberg, what is your reaction function? Does this make you less interested on the margins in buying 10-year or 20-year or 30-year treasuries?
Yeah, I've said in lots of different contexts with you guys that you have to just be careful about where you want to own your fixed income, that the yield curve move can be more important, more determinant to your fixed income returns than just the direction of interest rates. A lot of times we just think about you want to own bonds when rates are going down, when the Fed's cutting. You don't want to own bonds when they're hiking. But because the curve is so flat, we're off the peak of inversions, but it's still a historic lack of premium in that back end of the curve, that where you hold your duration is going to matter as much as how much duration you hold. So it's still that story for me. It's still the front end is a little bit better 5 years in. You want to be careful about that term premium. And the other thing that I'm highlighting here today is you just got to be careful about how much is already priced in. This is unique about the beginning of a Fed cutting cycle. We're about twice the amount of expected cuts priced at the onset. This was John Otter's article in Bloomberg. He highlighted this. It's a great chart. About twice the amount of historic Fed pricing, about over 200 basis points, whereas historically you come in and there's only about 100 basis points. So a lot is expected. It raises the bar for subsequent fixed income performance. We've had a great run, but that tells you a lot of the performances in the rearview mirror. And so you got to be more thoughtful about where you own that duration around the curve when we look forward.
Does it give you more confidence, though, to go into risk, Jeff?
Well, you know, I think the Fed did its best, and that was the interchange you just had with Dudley. The press conference challenge was give 50 without spooking the market. I think they're successful today in there. That's the response in terms of small caps. You only buy small caps when the Fed's cutting rates, when you believe in the soft landing and the denominator effect. The discount rate is dominating, you know, any of your concerns in terms of growth. So I think they navigated that pretty well. I think when you go forward, you know, it is a soft landing baseline. I think that's exactly what the SEP is saying. When you look at all of the other economic data outside of the labor market data, you know, it's all very good. It's all very supportive for risky assets. And the fixed income side, that's a carry story. We're pretty comfortable with that. You got to be a little bit careful that it's asymmetric, that at very tight spreads, any sign of recession. And I don't think we're really seeing the recessionary signs out of the labor markets. But you have to be cognizant of it, that is the one place where you're seeing some weakness. But I think this is still supportive to risky assets.
Just quickly, Jeff, November 7th, how different is that committee meeting going to be compared to this one?
Well, you know, as you pointed out, you know, you're coming on the backside of the election, but, you know, as Powell answered, they're going to try to avoid any kind of discussion on that. It's really going to be about the evolution of the data. You know, the interesting data point in terms of revisions, you know, we talk about data dependence. The problem is the data we're dependent on is not very dependable. All right, try that out slowly. But that's the payroll data, right? And so the revisions are going to be important. We're going to have another one. That's going to dictate a lot of the discussion. Without a deceleration, I don't think you're going to be talking about 50s, but they've clearly laid the groundwork here for a 25 in November, 25 in December. That's what I think will price back into the bond market. That's why you're seeing a little bit higher rates. If they deliver on that, then there won't be as much surprise or anticipation as we had in this meeting.
So, Jeff, let me ask the question that I suspect you hate being asked. And let's assume that you're being asked for a retail investor 60-40 simple portfolio. What should they do now, given everything you just said?
Yeah, I mean, the part of this discussion around the 40, around the fixed income piece, Mohammed, is that it's not the old 60-40. It's not this era where bond volatility is 3%. Bond volatility is 6 to 8% in the post-COVID environment. So the 40 side is really where we've got to do some rethinking. And that's where we talk about diversifying your diversifiers, thinking about different ways of finding ballast in your portfolio because of the uncertainty of how duration and risk-free rates are going to perform in a more inflation uncertain environment. That's the points about the yield curve and what's already priced in. So I think in that 60-40, it's really about you know, using different ways to find diversification and diversifying that 40 bucket away from kind of just piling into traditional duration.
Did I hear you say a more inflation uncertain environment?
That is what I said, yes.
I don't think that's what Powell thinks.
There's greater confidence that inflation is on a path to returning to 2%, but we're not at 2%. And that path, as we saw in the interchange, the shelter inflation, the uncertainty around how far we're going, and the wage inflation picture, right? There's a lot of confidence that we're moving towards there, but we're not quite there yet. That's the point about a more uncertain inflationary environment. And with respect to kind of negative stock bond correlation, which is really the driver of the 60-40 part. The challenge is that was really working well in your portfolio when inflation was missing from below. Inflation is still missing from above. And until you get back to the period where we have too little inflation, you're not really back to that halcyon days of fixed income and 60-40.
Jeff, this was perfect. Thank you, sir. Jeff Rosenberg there of BlackRock on the Federal Reserve decision. If you are just joining us, welcome to the program. It's a 50 basis point cut from the Federal Reserve with some dissent. The first dissent we've seen from a sitting governor on the FOMC going all the way back to 2005. Governor Mickey Bowman. Not a surprise for many of you who've followed some of those speeches over the last month or so. If you're looking at the equity market, just about attempting to hold on to an 8th day of gains on the S&P 500, and it's a struggle. We turned slightly negative on the S&P. On the Nasdaq 100, we're negative by 0.05%. Mohammed, just a final thought. What I heard from you then, if you have any confidence the inflation story is done, that we're on a one-way trip now back to neutral, which might be around 3%, are you suggesting that confidence might be misplaced?
I think it's too early to declare mission accomplished. We've come a long way, but there are inherent contradictions that still have to be sorted. John, this was historic. I mean, we're going to look back on this day not only as the beginning of the cutting cycle, but as having recalibrated what we mean by 50 basis point start to a cutting cycle. And we're going to look back, and either this will be the absolutely right bet, which is be preemptive on the labor market after you are reactive to inflation. This is a fundamental change in the reaction function. Or alternatively, we will look at this as being too aggressive. I'm hoping that it will be the first, because we all want the labor market to do well.
Of course, Michael McKee asked him about being preemptive, and he said data dependency or the totality of data. My big issue coming out of this is, do we understand the Fed's reaction function more, or do we understand it less than we did before?
I think we've got a lot of questions that still demand answers, and hopefully we'll get them over the next few weeks, but I doubt it. Once that data starts to come in, I'm looking forward to hearing from the rest of the committee, aren't you?
Oh, yeah.
Over the next few days.
This quiet dissents.
Yeah. Let's just see how close some of them were to actually going 25 and another 50. Mohammed, thank you. Just awesome. Thank you, sir. Appreciate your time. A pleasure, as always. Coming up on the close, a question: can we hold on to these gains? Look out for the team in just a moment. From New York City this afternoon, good afternoon. Thank you for choosing Bloomberg TV.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
In 2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people are optimistic about then. The fact is, we built essentially from scratch, with lots of supporters, a really mind-blowing level of innovation against emissions. And in the last 9 years, that's gone better than I would have expected. So only now could you even, plausibly be optimistic about the path of emissions. and someone who said, hey, nobody's ever scaled things up like this, the speed that we knew to before, they're welcome to say, hey, I'll believe this when I see it. You know, in the meantime, some people who care about this issue are really out, you know, trying to think, do we need permitting reform? You know, do we find, what new ideas haven't we found yet? You know, how do we fund people with those new ideas? How do we get the costs of these things down? How do we collaborate on a global basis? So we're still not at the point where it's guaranteed or even that it'll be easy, but at least there's a theory of change.
Top names at Jackson Hole are on Bloomberg.
I'd like to see us move toward a more real-time data set. So using new technologies, maybe some of the AI technologies, maybe we get better data as we move forward, but we've got to really focus on that with our economists and our analysts about, you know, where's the data coming from and can we rely on it?
Nobody covers Jackson Hole like Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
4.5 years since its last rate cut, about 14 months since the last rate hike. Bloomberg's coverage of the Fed decision continues right now, live from Studio 2 here at Bloomberg headquarters in New York. I'm Romaine Boston.
And I'm Alex Steele. And if I told you we had a jumbo rate cut and stocks may close flat and the bond market was selling off, you would not have believed me.
I kind of would have actually believed you.
Okay.
Oh, no, I wouldn't have.
You wouldn't believe me. Thank you very much. Even the Russell, which you think the small caps are going to be the stock index, it's going to do really well on this kind of jumbo rate cut, or even mid caps, they can't hold on to this as well. The Russell 2000 is just up by 0.1%. And I feel like, Romaine, if you take a look at the dollar and the 2-year, that does not encapsulate the drama that has unfolded over the last couple hours in terms of the market action.
And a big part of that drama was just the outsized nature of this cut and Jay Powell trying to thread that needle, giving the market some sort of reassurance that this was about, I think in his words, supporting a strong labor market, but not necessarily saving us from a weak economy. I don't think everyone's buying it.
No, slow your roll, but we have zero tolerance for low employment, for higher employment. I feel like that's the combo.
And of course, we came into this day not knowing if we were going to get that jumbo rate cut, as Alex was just talking about. Most economists out there were predicting 25 basis points, but Jay Powell went with 50. Here he is weighing in on today's decision.
I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is, look at the SEP. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level, and we're moving at the pace that we think is appropriate.
We're going to get some great insights on the big program today from a lot of folks, including former Fed Governor Betsy Duke, economist extraordinaire Claudia Sahm, and a conversation a little bit later here with the SEC Chair Gary Gensler. But let's start with the headliner. Ken Shinoda, portfolio manager over at Double Line Capital, flying all the way in from California just to see us here in New York. Ken, great to have you here.
Thanks for having me.
Were you surprised?
Not really surprised. I think that they were so behind the curve, hiking rates when inflation had picked up, that they wanted to tell the market that we're not afraid to cut. And so I think they did the right thing by cutting 50 basis points. It was kind of priced into markets this morning. And I think why equities have pulled back a little bit is while they cut 50, they're still data dependent. And they didn't get too dovish in his remarks.
Mm-hmm. Well, I'm curious about that, too, because when we talk about what the market expectations are, I mean, they gave some projections in that dot plot that seem to suggest they're going to be relatively aggressive with additional rate cuts going forward here. And I'm wondering why the market didn't find some solace in that.
Yeah, they're projecting another, call it 50 basis points to the end of the year, so we'll get another 25 the next two meetings, and then 100 over the next, through 2025. And I think maybe the market wanted to hear some more dovish language on we're going to get back to neutral quicker. They also moved the neutral rate up a little higher. Their estimation of the neutral rate moved up a little bit, so maybe that has something to do with it too.
Like 3.4%, right?
Yeah, but it was interesting though. I mean, 10 officials still see 100 basis point cuts or more. 9 see 75 or less. So it's still really wide for this year. So what do you do in the market? Like, is this a good time for corporate credit? Like, do you just sit tight on where you are in the curve?
Well, I think
choose a GAF Master Elite contractor. Only about 2% of roofers nationwide are Master Elite, and only they can offer GAF's best warranties. For an experienced contractor, choose a GAF Master Elite roofer.
Long ago. Now it's down to 3.5%. So you got to start increasing that duration of your portfolio. The timing isn't that great since we're at the lower end of the trading range, but you're never going to time the bottom perfectly, just like you won't in equities. So you got to start legging into more fixed income into your portfolios.
What about the corporate bond market?
The corporate bond market has had a great run from a spread standpoint. It's tightened a lot. It's very high quality, but just from a spread standpoint, it looks a little expensive, but I'd rather be there than in some of the riskier parts of the market. The credit curve is flattened a lot, meaning the yield pickup to go buy something riskier, like CCC high yield, for example, has come down a lot. So you're not getting paid that much more to take more risk. So I do like staying in the higher quality parts of the fixed income market.
Can you sort of elaborate on that as well? Because we're hearing the same thing from folks in the equity space saying, yeah, we're going to stay invested, but we're gravitating to things that are a little bit more safe or defensive or boring, I think is what one of our guests called it earlier this week here. But what does that mean? I mean, in terms of, because if it's not just the shortest of short-term duration in terms of, you know, doing NT bills and other money market type instruments, then where do you find that safety?
Well, high quality can also be out the curve. 10-year Treasury is high quality; it's government guaranteed. You could pick up additional yield by going into
locking in for 10 years, or taking that with the idea.
I'm just saying you can buy Treasuries to get high quality exposure. Gotcha. On top, the next step would be going to things like government guaranteed agency mortgage-backed securities. You get paid some spread to take on prepayment risk, and those look really cheap relative to history. And investment grade corporate bonds are another tool in the toolkit for investors where you can pick up a little bit of spread, but you're not really taking a lot of credit risk. I also don't mind the higher quality parts of, for example, high yield. Double B high yield, there's still pretty good quality companies. If you do your credit selection, you can pick up some additional spread there, and you're not going to the junkiest parts of the market.
When you look at past easing cycles at the start of it and the reaction that you got, let's take agency MBS, for example, mortgage-backed securities. Do you think we're going to see a similar repeat of those moves, or has that market changed so much from the previous easing cycles, or major easing cycles that we saw?
No, I think agency mortgages had been the value trap in fixed income for the better part of 2 years up until the last few months. They had just continuously lagged Treasuries and corporate bonds. And really part of the reason was the rates were so high, and a lot of investors need the short-term rates to come down to buy these assets on a levered basis. As the Fed cuts, this is the best environment for those assets. So I think we're going to see continued performance out of that and fixed income broadly. I do think we ran a little too far too fast. We're going to see a little bit of a pullback potentially. You're already seeing it today. Use that as an opportunity to add some more fixed income into your portfolios.
Yep, looking at the 10-year at 3.7 is where we sit right now. Before we let you go, how do you trade the next data point? And like, what is that now?
Well, per Powell's comments, I think it's a lot of it's on jobs, right? We want to see what's going on with the labor market. To get more aggressive cuts than they're talking about, we need to see a more rapidly cooling labor market in order to get kind of more aggressive views from them.
All right, Ken, great to have you. Got to leave it there. Ken Shinoda, portfolio manager over at Double Line Capital. Reaction here to the big Fed decision, and reaction, Alex Steele, to the market reaction, which I think, as you alluded to at the start of this program, not what I think a lot of folks expected. At one point, we did have a decent rally going on here, but that has faded in a big way.
It really has. And even in the mid caps, which you could argue should be the best beneficiary of this, at least that's what Bank of America thinks, right? Even there, they're barely up, just up by 0.1%. I do wonder, though, how much of this is going going to be position and position shakeout, particularly when some longs were taken off, like in the Treasury market. So once we get a cleaner read, will we get a cleaner read then on how the market will react to the Fed?
The volume really did pick up here in the final few minutes of trade, seeing a spike in the VIX here. And interesting, too, looking at that 210s curve now at the highest level that we've had going back to 2022. A full breakdown of all the market action coming up in a second, right here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele, taking you through the closing bell with a global simulcast that starts right now. Carol Master joining us in the radio booth alongside David Gura, filling in today for Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms, including our partnership here with on YouTube. And Carol, you talk about the market reaction to that Fed meeting, the market reaction to Jay Powell. Not quite what we expected.
No. First of all, I was surprised by the 50 basis points. Kind of shocked me. We saw such a significant, or decent, I should say, equity rally right off of that. And then we've seen stocks retrench. So I feel like investors are still trying to figure it out. Does 50 basis points, David, does it mean that there's some troubles ahead?
Yeah, and I just was struck by how emphatic Chair Jay Powell was during the course of that press conference, saying the Fed is not behind the curve here, saying things are different than they were back in July, saying this isn't a sign that they missed the ball back at that last meeting. Very forthright. Also, promoting a lot of clarity, a lot of caution going ahead to this next meeting that, it's not divine, it's not gospel what's going to happen next when they meet again in November.
But I am interested into the reaction function, right? It's very clear that they have zero tolerance for a weaker labor market. So what does that actually mean? So you get 1/10 of a tick up in the unemployment rate. What is that then reaction function? They're expecting 4.4% for U3 in 2024. So how do you then trade something like that?
And particularly, too, when we talk about this idea of that neutral rate coming up, at least their projection for it at 3.4%, definitely higher than what the market had priced in. So maybe you get a bit of a repricing. But as we always have to point out here, the market reactions that you typically get on the day of these Fed meetings can change in a big way in the days that follow. Here on this Wednesday afternoon, Fed Day, the screen looking a lot different than what it looked like just a few minutes ago. All red across the screen with the Dow Jones Industrial Average down roughly about 100 points on the day, or about 0.2%. The S&P 500 down about 16 points, or 0.3%. A similar percentage drop for the NASDAQ Composite, as well as the NASDAQ 100. And if you're looking for outperformance, well, there you have it on your screen, and it is minor outperformance. The Russell 2000 fractionally higher here on the day. We'll just call it unchanged. S&P mid-caps also similar move, and the Dow Transports a little bit better of a performance, though that's only up 0.4%.
Right, small caps at their highs today, up almost 2.5%. In terms of the S&P 500, though, if you look at it, almost an even split. More than 200 names actually gaining ground here at the close, 286 to the downside. So, Alex, a little bit more of a negative tilt.
Yeah, and you take a look at the IMAP. It is mixed, but I think that what it's mixed by is quite interesting. You have, well, actually, it's not that mixed. I was looking at mid caps. You're actually looking at the majority in the red. Utilities, though, not doing as great, and that's so interesting because if you were going to have a 50 basis point cut, you would have thought that utilities would have done really well, but that necessarily isn't the case today, which just shows that we can't really predict how the market's going to react to this. You have tech getting hit as well as financials.
Not a brat, Matt. That's a Matt, not on this Fed Wednesday. All right, let's get to some of the individual gainers, folks.
You're so hip, Carol.
She was just in LA. Was it LA? Where was she? She was somewhere cool.
She never tells us where
she was. Somewhere cool.
She just disappears
there we
in the
go.
high seas for days.
Highly recommend doing a show on the beach.
Yeah.
It's a really good thing.
Thanks for rubbing
We'll work on that.
Back on that, yeah.
You're all invited next time. All right, let's get to some of the individual gainers. GM finishing off its highs, at its highs up more than 4%, but still a 2.4% gain here at the close. A top gainer in the S&P 500. The company's EV customers can now tap into the Tesla I superchargers starting this month. Remember they had an agreement last year between Mary Barra and Elon Musk. So some upward sentiment, if you will, for General Motors. Victoria's Secret, check it out, guys, up about 3.5% here. The company was upgraded. The stock was to equal weight from underweight over at Barclays, which said the worst is behind the company. Also raised the price target to $25 a share from $23. So the stock finishing pretty much at $25 a share in today's session. HubSpot, another one, an outperformer, up 2.3%. Call options also tripling today. Our BI team out with a note talking about the company's analyst day, saying the company's position in sales, marketing, and service software continue to strengthen in the small and medium-sized business segment due to AI innovation and more. And they also noted some of the company's product launches. So that's some of the outperformers here today, David.
Looking at those underperformers today, a few caught my eye. Zegna Group, maker of men's suits, men's clothing, Italian company, went public via SPAC back in 2021.
I think Romain, your suit came from there.
I didn't want to call him out. Perhaps it did.
He has a whole wardrobe here. That's the thing.
Anyway, flagging that profits were lower there at that company in the first half of this year compared to the quarter and a half before
so
that.
I can expect some discounts?
There you maybe. Before
so
that.
I can expect some discounts?
There you maybe
Now you're talking my language.
Check it out. Anyway, kind of emblematic of the fact that luxury is going through some difficult times here. The CEO saying today that it's going through an important normalization phase given macroeconomic and geopolitical uncertainties, and the overall environment is expected to remain even more challenging in the weeks and months ahead. Another company suffering a little bit today is Cisco, food distribution company. The CEO of that company speaking at a Wells Fargo consumer conference in California today, saying that traffic is down at restaurants by as much as 3 or 4% and sees that being a persistent problem going forward here. That company closing lower. And then Trump Media and Technology Group. We are at this pivotal moment. Of course, Donald Trump owns more than half of that company's stock, more than $1.8 billion worth of it. The lockup period by which he can't sell that stock ends tomorrow, provided those shares don't close lower than $12. He says he's not selling. We'll see, but the company continues that kind of downward slide we've seen since March, when this company was trading above $60 a share, far below that today.
So that's sort of the micro look. On a macro level, we go back to the bond market. We're looking at a sell-off all across the curve. You got the 2-year yield up 3 basis points. The 10-year yield is up 7 basis points. That's the most since August 15th. I know it doesn't seem like that long ago, but a lot has happened since then. But what's so interesting, if you look at an intraday chart of what the bond market did, particularly in the 2-year, you get a 50 basis point cut, you got buying right away, and the yield falls. And then as the conversation continues and the presser gets underway, and it seems like the Fed is in no rush, you guys, to do any more 50s. They're in no rush to cut dramatically and drastically, and then you wound up seeing the selling kind of pick up, particularly on the long end.
There's a big question that I have, though, and the question is, when we look at the targets that they have on the dot plot and what Jay Powell said today, how much can you really take that as gospel here? I thought Mike McKee, when he sort of broke the news at 2 p.m., he pointed out a couple of big things. This was the first dissent that you've had on the FOMC since 2022, and the first dissent by a Fed governor since 2005. And he seemed to suggest here that this might be an expansion of that type of dissension going forward over the next few meetings as everyone tries to figure out where we're going.
Which makes you think about the future discussions, right, around the dot plot as new data comes in. I was thinking about tomorrow at 8:30 a.m. Wall Street time, weekly jobless, like these weekly reports, which are much more timely data than the monthly jobs report, David, become even maybe more important.
We just have to keep thinking about the crucible in which this is happening. Of course, we have an election coming up. This was the last meeting before that election. The next Fed meeting takes place a day after people go to the polls here in the U.S. This Fed chairman emphatic, as he has been before, growing increasingly irritated, I think, with this question that the Fed might be susceptible to political influence, saying that wasn't the case here. That's not going to be the case going forward. But we already have a statement from Vice President Harris applauding the Fed for the move that it made today. And then we have Donald Trump, the former president, here in New York tonight at a big rally in Nassau County. He's trying to get folks elected down ballot, House races in Hudson Valley and in Long Island. No doubt this is something he's going to bring up during the course of the speech that he gives tonight. So we'll be listening closely to what he has to say. He's kind of questioned the merits of the Fed's sort of very storied independence in past speeches.
Mention SALT and all of us in the New York metro area.
True.
It definitely catches our attention.
We start to pay attention again. It's 100% true. But if we go back to where we were last Thursday, so that was more of the 25 camp, right? And then you had the Wall Street Journal article come out on Thursday night where Nick Timrose talked about the fact that 50 might be on the table. Then you saw the market re-rate on Friday, and that continued. So in my mind, don't you just like kind of check out and check back in 4 days until the next Fed meeting and see what we're talking about? I mean, that's kind of what happened.
I think that is kind of what happened. It's kind of basically the Fed did meet the market, and the market was happy with that. And like I said, what happens over the next couple of days? But I thought, just to David's point, too, about the political I don't know, implications, if you will. I know Biden is supposed to speak on this tomorrow. You do wonder how this is going to sort of play into the election cycle as people now start to talk about inflation coming down. Maybe interest rates ends up being a net positive for some people's pocketbooks. I don't know if it's going to come that fast, but that'll surely be the pitch that you might hear out of Harris and Biden. I don't know if you're going to hear that from Trump because, you know, why?
Well, all I would say off of that is watch the housing market, watch the mortgage market, right? If people start to buy houses, that's certainly some economic activity. That would be a new trend that we haven't seen in some while. If we start to see,
I have a dream of buying a house one day.
It'll happen. It'll happen.
Well, if you stop buying new suits, you might
right,
be able
there we go.
to
It all comes full
afford.
circle.
No, but he needs the brownstone for the suits. Guys, it all works together.
Yes.
It does, it does, it does. All right, great wrap up, you guys, on this Fed Day. That's our cross-platform coverage. Radio, TV, YouTube, Bloomberg Originals, we do it all. Those guys continuing, certainly on the TV side of things, and David and I are going to continue here on Bloomberg Business Week on Bloomberg Radio. We'll see you again, same time, same place tomorrow.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
All right, we're done with Fed for a while.
Okay.
Until
Fair enough.
November 7th and the lead up till that.
Months, yeah.
All right, this story definitely catching our attention. It's a Bloomberg exclusive, a most read story on the Bloomberg about the billionaire hedge funder, one of the best known names, I would say, in the hedge fund universe. Dominated, David, the industry for 3 decades. He's had some very public ups and downs, owns a major sports team, and has even been brought to life in a streaming series.
Yes, Steve Cohen, who currently runs Point72, announcing he's going to be stepping away from sort of day-to-day trading at the firm. And Kathy Burton has written about that for us here at Bloomberg. Kathy joins us now in the Interactive Brokers studio. Kathy, great to see you.
Nice to see you.
What prompted this move? I mean, I was saying to Carol earlier, he's done this before. He's threatened to do this. He's walked away from day-to-day trading before. Why now? And is this time, do you think, different than in the past?
It's really hard to say because he has done it before. He said, okay, I'm not going to trade anymore, but he is very much an animal of the markets and always has been. And so it's possible that if things get really crazy around the election, he could step in again. But I think really the idea is that he thinks that he does more good mentoring people, working with other traders than doing his own book, especially because the firm is so big now.
Does his investors agree with that?
Yes, because I think over time,
the next generation?
He's been cutting back.
Okay.
Like even a year ago, this time of year, he apparently was trading less than he had before. So, and people are pretty happy with the performance. And so they think it's big enough now, there's enough teams. It's not like just old school SAC when he was running the show.
For those who don't know, how big a firm is this, and sort of how much is it him? How much is it Steve Cohen's firm? How much influence does he have? I know it's a co-CIO position. What's the relationship like with the other CIO, and sort of how much has he been running it and calling the shots?
Well, I think if you go back to when it was SAC, he was calling a lot of the shots. It was his firm. But now I think he really does it. Like his portfolio would have been a tiny percentage of the $35 billion that they run.
I was going to ask how big the book is. I mean, is it a big?
Yeah,
big, relatively speaking, I suppose.
So if he's doing $1 billion or something, that's still not that much percentage-wise of $35 billion firm, and I doubt it was even that large. But
one of the things I love about your reporting is that you remind us of kind of who he was, and even as a kid. I mean, he does really love to trade, which kind of goes from how we started. That you do wonder if he'll be drawn back into it. Remind us kind of about who he was, even as a young kid, and his kind of love of the stock market.
Yeah, well, we were told when we wrote a profile of him back in the day that he would, when he was at Wharton, he would actually leave class and go and just watch the tape.
He'd skip class to do it.
Yeah, and he just got a feeling of how stocks would move.
There was this period when there was a settlement with the SEC. He stepped back. He wasn't managing money for 2 years. No. What was that like? What do we know of what that was like for him? And sort of, I mean, you hit on this in the story. It is a remarkable renaissance here to go from that, and he was never himself charged with anything or tried, but to have that kind of rebirth, how astonishing is that? And how did he manage it to do that?
It is astonishing. I mean, I think it helped that even when he opened the doors again, he's had $10 billion, which is a pretty big amount of money.